The latest consumer price index came out on Wednesday, that's September 11th, for August, and it showed that inflation continued on its downward path. The overall index rose just plus 0.2%, and that's for the month of August, and 2.5% from a year ago. That's the lowest that annual number has been since all the way back to February of 2021. That's 3.5 years ago. The core rate of inflation, which excludes food and energy, rose 0.3% in August and 3.2% on a year-over-year basis. And that 3.2% number was tied for the lowest level since April of 2021. Then on Thursday, the Producer Price Index, a measure of inflation at the wholesale level, came out with similar readings. The PPI increased 0.2% in August and is now up just 1.7% from year earlier levels. Core PPI, again, excluding food and energy, rose 0.3% in August and is up 3.3% for the year ended in August. To show the progress on inflation, looking only at the last 3 months of the CPI and annualizing those numbers puts the headline number at 1.1% and the core at 2.1%. In my weekly blog on Forbes, I have discussed the computational issue that is part and parcel of the construction of the Consumer Price Index. The issue is that the shelter component, mostly rents, which has a 36% weighting in the index, is lagged. That means the data is not current, and in fact, the rent data used by the Bureau of Labor Statistics to construct the index is 9 to 12 months old. If they used an up-to-date index, like the apartment list index, that shows on a national basis rents have actually fallen 0.7% over the year ending in August, we would have a much lower rate of inflation. If we exclude those old rents from the Consumer Price Index, that index behaved quite well. 0% in August, 0% in July, and minus 0.2% in both June and May. And remember, current rents are falling, so if they were included, we would actually be seeing some mild deflation. For some reason or other, and despite the fact that the last 3-month trend is what is most likely to continue in the near future, markets like to look at year-over-year comparisons. So looked at from this perspective, year-over-year, if we exclude rents, the Consumer Price Index was flat, 0.0%, for the 2 months, July and August, and rose just 1.1% from a year earlier. In July, that number was plus 1.7%. So you can see just how rapidly inflation is subsiding. Meanwhile, the Fed is about to make its first mini move to lower historically restrictive interest rates, because I think the Fed is late to the party or behind the curve in easing monetary policy. And let's not forget that there's a long lag between when the Fed implements monetary policy and the impact of those changes on the economy. I expect the disinflation we have right now, slower price increases, will actually become deflation, actual lower prices by year's end. We've already begun to see this in the prices of gasoline at the pump. To reiterate, the inflation genie has been put back into the bottle as inflation is now effectively at the Fed's 2% goal. Meanwhile, the Fed is about to take its first baby step, likely a 25 basis point rate reduction, toward easing its historically restrictive monetary policy. By the way, market odds of a 50 basis point rate reduction remain around 30%. In my view, the Fed is behind the curve, and that is why I believe that a bout of deflation, that is falling prices, lies ahead. Consumers should cheer this.